Now let us understand treasury stock in greater detail. How it's shown in the balance sheet, what are the accounting entries, how it's recorded, etc. Treasury stock, what did we understand was treasury stock? The shares which are purchased by the company. The company purchases back its own shares. Why would a company purchase its own shares? Why do you have treasury stock? So when a company purchases its own shares, these shares could be cancelled. If they are cancelled, they are out. But if they are not cancelled, they are not retired, then these shares are referred to as treasury stock or as treasury stock. Why do you have treasury stock? Why does a company have treasury stock, buy back its own shares? Let us look at them one by one. First, the company has a lot of idle cash and finds that its shares are undervalued. So it sees that in its market, it feels that this share is worth much more. Maybe the company feels that the shares should be worth around $90 each, but they are quoting in the market at only $60, maybe. So the company thinks that its shares are undervalued. They know, they believe in their company, they know that it will do well, and they have some idle funds. What do you do when you have idle cash? When the company has idle cash lying with it, it will make some temporary investment. It will buy either shares or put it in the bank or make some use, make a small short-term investment, so that they can later on they can, if they need, sell the investment and get money. But right now they have a lot of idle funds which they could utilize otherwise. In such a scenario, they could buy its own shares. Instead of buying some other investment, they buy its shares since they feel that these are undervalued in the market. It would be profitable for them to do so. Next, if the company buys back its own shares, then the number of shareholders will reduce because they buy from a large number of shareholders, and therefore now only company holds those shares. To that extent, the number of shareholders could come down. The moment the number of shareholders come down, then the earnings per share and the return on equity, the return to the outside shareholders, increase. It increases the earnings per share because this treasury stock, it does not get dividend. It is not considered. It is reduced from the amount of share capital, and therefore it increases the earnings per share and it increases the return on equity. These shares, sometimes when the company buys its own shares, these same shares are reissued. These same shares are reissued to the employees as a part of the stock option scheme. Next, to stabilize or increase the stock price, when the shares are undervalued and when the company buys its shares, there is a lot more confidence in the market because the company is buying back the shares, and therefore the prices are not allowed in large quantities. So the prices are not allowed to fall dramatically. So it will stabilize the prices if they were following, or it may even increase the stock price since there is a buying pressure. The company is buying these shares. So these are some of the reasons why a company may buy back its own shares. So as we discussed before, the treasury stock, the shares which are bought back by the company are reduced from the issued paid up capital. They are reduced from the issued paid up capital. Now, when you buy back your own shares, what is your entry? If you were buying shares of another company, we would say investment. It would become investment debit, right? Money goes out to bank. Investment debit to bank. Now, when you are buying treasury stock, the entry is nothing but treasury stock. So, these are like your assets in the sense you've bought an investment, treasury stock to bank, right? But we don't really call it an asset. It's its own shares which it's bought back. It's a contra equity actually. So this is shown as a reduction from stockholders' equity and not as an asset asset on the asset side of the balance sheet. Treasury stock or shares have no voting rights, no dividend rights. They are accounted for either the cost method or the par value method. We'll be discussing the cost method, which is the more widely used method. So treasury stock is nothing but when a company has bought back its own shares. Clear? The entry would be treasury stock debit to bank, but understand that though we have debited treasury stock, it is not really an asset. It is more like a contra equity. Contra equity. It will be shown as a reduction from capital, from equity. Of course, these treasury shares have no voting rights, no dividend rights. What is the next? Let us look at the accounting entries. Actually, there is the cost method or the par value method, but we will be discussing the cost method. Now, 1000 shares of par value 10 is purchased from the market at $12. What would be the entry? Treasury stock, we purchase it at 12, to bank 12. But we are talking of 1000 shares. So treasury stock would be 1000 into 12, right? 1000 into 12, to bank 1000 into 12. Clear? This treasury stock debit is not really an asset. It is what do we call? We say contra equity. Contra equity, and shown as a deduction from owner's equity, from capital stock. Assuming that the company had a contributed capital of 400,000 and retained earnings of 200,000, purchase of own shares would be reflected as below. Common stock is 100,000, additional paid in capital was 300,000. This is the same example that we had done before. 400,000, retained earnings is 200,000, totally 600,000 minus the treasury stock of 12,000. And therefore you get total stockholders equity of 588,000. This is how it is presented in the balance sheet. Is it clear, students? So you take the capital, you take the APIC, additional paid in capital, total capital, retained earnings. This is the total owner's equity if shares have not been bought back. But if there is treasury stock, reduce that from this and you will get the net owner's equity. Now, this treasury stock can be reissued. There can be reissue of treasury stock. Then what do we do? At a later date, when you reissue treasury stock, it may be at a gain or it may be at a loss. Reissue. What is reissue? I sell this treasury stock, the shares that I've bought, I sell it maybe in the market again. This may be at a gain or at a loss. This gain is not taken to the income statement. It is not an ordinary gain, a gain from ordinary business activities. It is credited to an account called additional paid up capital from treasury stock. Additional paid up capital from treasury stock. Clear? Any profit will have a credit balance, right? So this, when you're issuing stock, if you make a profit, take it to additional paid up capital from treasury stock. But what happens if you make a loss? Then if you have additional paid up capital from treasury stock in your books because you made some profit earlier on, then you can adjust the loss against that. Is it clear, students? So it is possible that 2 years before, when I had reissued treasury stock, we made profit and therefore put it in which account? Additional paid up capital from treasury stock. Now, when we are 2 years later, now when we are trying to reissue stock, we are reissuing it at a small loss. What do? This loss you can adjust against this additional paid up capital from treasury stock which was formed 2 years back. If not, if you don't have additional paid up capital from treasury stock, you just adjust it against the retained earnings. Is it clear? So once you have bought back the shares are either retired, cancelled, or they are reissued. So when they are reissued, such a reissue may be at a gain or at a loss. If it is at a gain, that gain amount is not taken to income statement but taken to additional paid up capital from treasury stock. But if there is a loss, such loss, what do we do to the loss? Such loss is adjusted against additional paid up capital from treasury stock. Or if we don't have such an account, we don't have balance in this account, adequate balance in this account, it is adjusted against retained earnings. Reissue of treasury stock at a gain. Say for example, 1000 shares of par value of 10 is repurchased from the market at the rate of $12 each. 400 of these shares are reissued at $15 each. So we had already made entries for this 1000 shares repurchased at $12, right? Treasury stock 12,000 to bank 12,000. This was our first entry. No problem here. Now, out of this 1000 shares, 400 of these shares are reissued for 15. So the money that comes in is 400 shares into 15. Yes or no? So let us say $6,000 comes in. To treasury stock, we say 4,800 because we had purchased at 12. So bank account, basically what we are saying is the money received bank is 15, right? To treasury stock is the cost at which we bought and the difference is APIC 3. Is that correct? So bank is 15 into 400. Treasury stock is 12 into 400 and the remaining 2 is additional PIC 2 into, not 2, it's 3, right students? It's 3. 3 into 400, 1200. Clear? Color? So when we bought treasury stock to bank 12,000, whatever price we bought it at, cost method, whatever cost we bought it at. When we reissue, bank money that comes in to treasury stock, the cost at which we bought, the same value. The difference is either profit or loss. If it's profit, it is taken to APIC from treasury stock. If it is a loss, we adjust it against APIC, if any, otherwise against retained earnings. Now let us look at the balance sheet. If you remember, the balance sheet before you had 100,000, 300,000 and therefore that was 400,000. Right? Now we have additional paid in capital from treasury stock 1,200 from our previous example. Here we have 1,200. Yes or no? Additional paid in capital on reissue. 1,200. That is coming. Retained earnings was 200,000. So we have 600 and 1,200. Then we reduced treasury stock. How much stock we had? 1,000. Out of that, 400 was reissued. So we have 600 shares at the rate of 12. We reduce that and we get 594,000 as the shareholders' equity. Is it clear as compared to the previous time? Previously we had 100, 300. We did not have this previously. We had retained earnings. Our treasury stock was how much? Our treasury stock was not 600 shares. It was 1,000 shares. It was 1,000 shares. Yes, is it clear? Okay, next. Suppose we reissue at a loss. It could sell at a price lower than its cost, then there would be a loss, and we said such a loss is debited to the additional paid up capital from treasury stock or the retained earnings. So 1,000 shares of par value of $10 is repurchased from the market at $12. 400 of these are reissued at 15 and another 200 shares are reissued at 9 per share. Treasury stock 12,000 to bank we did. Bank account to treasury stock to paid up capital to APIC is 1,200. This is what we did before. So this is up to here, right? This much we've already done. Now suppose another 200 shares are reissued at 9 per share. What would the entry be? If I take just one share, it should be bank account, debit, I get 9. But to treasury stock, I will take 12. So the difference will be 3, which I could put in APIC. Is it clear? Because I already have an APIC from treasury stock. So let us look at this entry. Bank account is 1,800. Additional paid in capital from treasury stock 600 to treasury stock 2,400. Because I am talking of 200 shares only. 9 into 200, 3 into 200 to treasury stock 12 into 200, 12 into 200. 12 into 200, right students? Okay. Now let's look at the capital. It was 100,000, 100, 300. You had additional paid in capital 1,200. Now it's become 600. Why? Why 600? Because we debited 600. We had 1,200. We removed 600. This is a credit balance. We used it up when there was a loss. So we have now only 600. Okay. Retained earnings is the same. Treasury stock. Here we had 600 shares. Now we have 400 shares at the rate of 12 each. Is it clear? Clear, students? Make a comparison. Any doubt? Be very thorough. Go back if you have any doubt. Confirm. Be sure. Treasury stock, we started with 1,000. Then we reissued 600 at a profit. And next we reissued 200 at a loss. Continuing the same example, the company now has a balance of $600 in the APIC and another 300 shares, let us say, are sold for $5. Then what happens? We are doing the same example. The company has a balance of 600 in the APIC. This is what we have seen, right? Now you are selling 300 shares for $5. When you do that, 300 into 5, you get 1,500. This is clear. But treasury stock is going to be 300 into 12, 3,600. Right? So now I have to take care. I need another 2,100. I need 2,100 is my loss. Right? How much do I have in the APIC from treasury stock? Only 600. Yes or no? 600 I use from APIC from treasury stock. And the remainder amount of 1,500 I take from retained earnings. Is it clear? So if there is not enough APIC in treasury stock, from treasury stock, then I use the retained earnings. What is available is used up and then remaining taken from retained earnings. Look at the balance sheet now. Previously we had 100, 300 and you had 600. Now you don't have that, right? So this is clear. Retained earnings was 200,000. Here now 1,500 has gone. 1,500 has gone. That is less. And treasury stock you had 400 shares. Now, did you have 400 students? You had 400 shares. Now you have, how many shares do you have now? You will have only 100 shares. You will have only 100 shares. This is 100 shares, right? 100 shares into 12. And here you had 400 shares into 12. Because you sold 300 of the shares. Therefore, this is the shareholders' equity now. Clear? No change in common stock, additional paid in capital. But this was entirely used up. APIC from treasury stock was entirely used up to write off the loss. So to that extent, but it was not enough. There was more loss. So we took it from the retained earnings. That has also come down. then we reduce the amount of treasury stock from this capital to get how much do we reduce? We have 400 shares before. Now we have only 100 shares because 300 shares were issued at a loss. Now we have 100 shares. So reduce the treasury stock, the cost of the treasury stock, and finally you get the total shareholders' equity.